There is one financial decision that millions of Americans get wrong every single year. Not wrong in a dramatic, catastrophic way. Wrong in a quiet, compounding way that takes decades to reveal itself. And by the time most people realize the mistake, the opportunity to fix it is partially gone. The decision is this: Roth IRA or traditional IRA. Most people pick one of these accounts based on what they heard first, what their parents used, or which one their brokerage app suggested when they signed up. A surprising number of people contribute to a traditional IRA when a Roth would have served them dramatically better, and vice versa. That seemingly small choice, made once and rarely revisited, can be worth tens of thousands of dollars over a retirement-length investment horizon. The good news is that the right answer for most people is not that complicated once you understand what actually makes these two accounts different. Not just the surface difference, but the deeper logic of when each one wins. This video gives you that logic. And at the end, a simple decision framework that tells you exactly which one to use. In the next 10 minutes, we are going to cover exactly what makes these two accounts different. The one question that determines which is right for you, for specific scenarios with clear answers, the 2026 limits and income rules from the IRS, and what to do if your income is too high for a Roth IRA. This is wealth clarity. Let's get into it. Let's start with the simplest possible explanation of what separates these two accounts. A traditional IRA lets you put money in without paying tax on it now, but you pay tax when you take it out in retirement. A Roth IRA requires you to pay tax on your money now, but you never pay tax on it again. Not on the growth, not on the withdrawals, not ever. That is the entire difference. Everything else, the income limits, the contribution rules, the withdrawal requirements, flows from this single distinction. Here is the practical implication. With a traditional IRA, you are making a bet that your tax rate in retirement will be lower than your tax rate today. If that is true, deferring the tax until retirement saves you money. With a Roth IRA, you are making a bet that your tax rate in retirement will be the same or higher than today. If that is true, paying the tax now and letting the growth compound tax-free saves you money. The entire Roth versus traditional question reduces to one core question: will you be in a higher or lower tax bracket when you retire than you are right now? If you genuinely expect to be in a lower bracket, traditional often wins. If you expect to be in the same or higher bracket, Roth almost always wins. And for most people under 45, the Roth wins for reasons we are about to cover. Before we get to the decision framework, here are the exact 2026 numbers directly from the IRS. Because these change annually and most information online is out of date. The contribution limit for 2026 is $7,500 per person, or $8,600 if you are age 50 or older. The catch-up amount increased to $1,100 in 2026, up from $1,000 in previous years. This limit applies to your total IRA contributions across all accounts, so if you have both a Roth and a traditional, you cannot put $7,500 into each. The combined total cannot exceed $7,500. For the Roth IRA, there are income limits that determine whether you can contribute at all. For 2026, single filers must have a modified adjusted gross income below $153,000 to make a full contribution. The phase-out range runs from $153,000 to $168,000, meaning partial contributions are allowed in that range. Above $168,000, single filers cannot contribute to a Roth IRA directly. For married couples filing jointly, the full contribution is available below $242,000. The phase-out runs from $242,000 to $252,000. Above $252,000, joint filers cannot contribute directly. For a traditional IRA, anyone with earned income can contribute regardless of how much they earn. However, whether your contribution is tax-deductible depends on your income and whether you have access to a workplace retirement plan like a 401k. If you have no workplace retirement plan, your traditional IRA contributions are fully deductible at any income level. If you do have a workplace plan, the deduction begins to phase out for single filers above $81,000 in 2026. These numbers matter because they determine not just which account you can use, but how advantageous each one actually is for your specific situation. Now let's make this practical. Here are 4 specific scenarios with clear answers for each one. Scenario 1. You are in your 20s or early 30s, earning between $40,000 and $90,000 per year. This is the clearest case for the Roth IRA. Here is why. You are almost certainly in the 10, 12, or 22% federal tax bracket right now. Over a 30 to 40-year career, most people move into higher brackets as their income grows. Paying tax at 22% today to lock in tax-free growth for 40 years and tax-free withdrawals in retirement is an extraordinary deal. Time is the Roth IRA's greatest advantage, and you have the most of it right now. Roth wins clearly. Scenario 2. You are in your 40s or 50s, earning between $100,000 and $160,000 per year, and you are in the 24 or 32% federal tax bracket. This is where it gets more nuanced. At higher current tax rates, the immediate deduction from a traditional IRA becomes more valuable. If you genuinely expect to spend significantly less in retirement, drawing down at a lower rate, your retirement tax bracket could be lower than today, making the traditional deduction worthwhile. However, there is a hidden risk many people miss here. Required minimum distributions from traditional IRAs begin at age 73, and they are often larger than people expect, potentially pushing retirees into higher brackets than anticipated. For most people in this scenario, a split approach works well, contributing to a traditional 401k at work for the immediate deduction while also funding a Roth IRA for tax-free diversity. The best of both worlds. Scenario 3. You are a high earner above the Roth income limits. $168,000 for singles or $252,000 for joint filers. You cannot contribute to a Roth IRA directly, but the backdoor Roth IRA exists specifically for you. Here is how it works. You make a non-deductible contribution to a traditional IRA. Anyone can do this regardless of income. You then convert that traditional IRA to a Roth IRA shortly afterward. Because you made the contribution with after-tax money, there is little or no additional tax owed on the conversion. The result is money in a Roth IRA with all its tax-free growth benefits, regardless of your income. This strategy is completely legal and explicitly acknowledged by the IRS. It is the standard approach for high earners who want Roth benefits. Scenario 4. You are closer to retirement, in your late 50s or early 60s, and you expect your income to drop significantly when you stop working. This is the strongest case for the traditional IRA, or for maximizing your traditional 401k. If you are currently in the 24 or 32% bracket, and you expect to retire into the 12 or 15% bracket, deferring that tax makes mathematical sense. You are essentially shifting income from a high tax period to a low tax period, which is the exact situation traditional accounts were designed for. However, and this is critical, if you have significant traditional retirement savings and are approaching required minimum distributions, consider doing Roth conversions in the years between retirement and age 73 to reduce the size of those future mandatory withdrawals. There is one more consideration that almost no video on this topic covers, and it can change the answer for some people. Financial planner Larry Russell articulated it directly. For savers who reinvest the tax refund from a traditional IRA deduction, the traditional often wins mathematically. For savers who spend that refund, the Roth wins by forcing discipline. Here is what that means in practice. When you contribute to a traditional IRA and deduct that contribution from your taxes, you get a refund, or a reduced tax bill, equal to your contribution times your tax rate. On a $7,500 contribution in the 22% bracket, that is roughly $1,650 back in your pocket. If you take that $1,650 and invest it, put it into a taxable brokerage account, add it to your emergency fund, or contribute it to another retirement vehicle, then the traditional IRA does produce better mathematical outcomes in some scenarios. But if that money disappears into everyday spending, which is what happens for most people, because a tax refund does not feel like an investment, it feels like found money, then the Roth IRA's forced discipline wins. You pay the tax. The money stays invested, The growth compounds tax-free. There are no decisions to make and no temptation to redirect the savings. Be honest with yourself about which type of person you are. Both accounts can win mathematically, but the best account is the one you actually use correctly. Here is the complete decision framework in 3 questions. Question 1. Will your tax rate be higher or lower in retirement than it is today? If higher or the same, Roth. If clearly lower, traditional. If genuinely uncertain, split between both. Question 2. Do you earn above the Roth income limits? If yes, backdoor Roth. The strategy is legal, established, and used by millions of high earners every year. Question 3. If you choose traditional, will you actually invest the tax savings? If yes, traditional can win mathematically. If no, Roth wins by removing the temptation. For most people under 45 earning below $150,000, the answer is Roth IRA clearly and confidently. The combination of time, tax-free growth, no required minimum distributions, and the flexibility to withdraw contributions at any time without penalty makes the Roth IRA one of the most powerful retirement tools available to ordinary earners. Open one at Fidelity, Vanguard, or Charles Schwab. Contribute $7,500 per year or as close to that as your budget allows. Invest it in a simple index fund. Leave it alone for decades. That is it. That is the strategy. Here is everything we covered today. A traditional IRA gives you a tax break now and taxes you in retirement. A Roth IRA taxes you now and gives you completely tax-free growth and withdrawals forever after. The right choice depends primarily on whether your tax rate will be higher or lower in retirement than it is today. The 2026 contribution limit is $7,500 or $8,600 if you are 50 or older. Roth income limits are $153,000 for singles and $242,000 for married couples filing jointly. Above those limits, the backdoor Roth is your path. For most people watching this video, younger earners, people in middle income brackets, anyone who is unsure about future tax rates, the Roth IRA is the right answer. Pay the tax now. Let everything else grow forever. If this video gave you the clarity to actually make this decision, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube will show you the perfect next video right on your screen. I'll see you there.